Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, December 6th, 2023. Hope everybody's having a good day out there. Not the greatest day in the markets. Lots of red here in the domestic markets. Much better over in Europe and kind of mixed over in the overnights in Asia. So again, hope you're having a good day. If it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, like, share, subscribe, follows, and press that notification bell. All righty, let's go ahead and get into the numbers for today. Make that a little bigger. Dow Jones was down 0.19%, 70 points, closed at 36,054. S&P 500 was down 0.35%, closed at 4551. NASDAQ down 0.58%, closed at 14,146. The VIX was up 0.7% today. It's at 1294. Canada was down 0.5%. Brazil was down 0.96%, and Mexico down 0.09%. Over in Europe, Germany was up 0.75%. The UK up 0.34%. France up 0.66%. The Netherlands up 0.27%, Spain up 0.19%, Italy up 0.81%, Switzerland up 0.34%, and Portugal up 0.51%. So, like I said, West Europe did pretty good today. Russian exchanges, both red, MOEX down 1.59%, the RTSI down 1.96%. In the Asian markets, the Nikkei in Japan was up 2.01%, Australia up 1.65%, New Zealand up 1.28%. In China, the Shanghai was down 0.11%, the Shenzhen component up 0.2%, China A50 down 0.01%, DJ Shanghai up 0.05%, Hang Seng up 1.03%, and the Taiwan weighted was closed again. All right. So like I said, kind of a mixed day, and here in domestically, it just kind of looks like people are kind of waiting to see where things are going to go long term. Looks like the short-term rally we've been on for the last few weeks is looks like it's running out of steam again. So we shall see what happens. All right, let's go ahead and get to the market recap. U.S. stocks give up gains. Even as a slowing jobs market boosting rate cut hopes. All right, U.S. stocks retreated as investors process softer jobs data, fueling expectations of an imminent Federal Reserve rate cut. Again, where's this imminent? I mean, we have had zero deflation. Inflation has slowed down its growth, but we haven't really had any deflation. ADP's report revealed that private U.S. employers added only 103,000 jobs in November, falling short of the anticipated 130,000 and signaling a decelerating job market that could prompt a Fed rate cut in early 2024. This follows Tuesday's jobs data showing job openings at a 2-year low. The upcoming releases of weekly initial jobless claims and non-farm payrolls are expected to provide further insights. In corporate updates, Campbell's Soup saw its stock rise over 4% after exceeding quarterly profit expectations, buoyed by increased prices for packaged meals and snacks. Conversely, Brown-Forman's shares dropped over 6% as the whiskey maker lowered its net sales forecast for 2024, reflecting a shift in consumer preferences towards more affordable alternatives in the U.S. Toll Brothers led a rally in home builders, rising over 2% following positive quarterly results and optimistic projections for home buying activity amid recent declines in mortgage rates. However, MongoDB, a cloud data storage company, witnessed a more than 8% decline despite reporting strong quarterly results, showcasing a nuanced market response. Oil prices dipped below $70 a barrel, hitting their lowest since June in response to larger than expected draws in weekly U.S. inventories, but also increased gasoline supplies. The broader energy sector declined over 1%, with ExxonMobil down 1.3%, despite the company announcing plans to accelerate share buybacks after completing its $60 billion acquisition of shale producer Pioneer Natural Resources. The energy market continues to face challenges as U.S. crude production reaches record highs. Yeah, it's kind of been a tug of war with, the OPEC countries trying to reduce supply to keep the price up, and us, pumping domestically because we're actually pumping a lot of oil here. Frankly, I would like to see a lot more, but as far as capacity wise, we are pushing a lot of oil out of the ground. So. But we'll see what happens because, in my opinion, energy is what really is affecting everything as far as inflation across the board, because it costs, regardless of turning on your lights or driving somewhere or moving your food around the country, that all, takes energy to do. All right, next up, private payrolls increased by only 103,000 in November, below expectations. Private sector job creation slowed in November, with companies adding just 103,000 workers, slightly below October's revised figure of 106,000, and missing estimates. Annual pay growth was 5.6%, the smallest increase since September of 21, and wages for job changers rose 8.3%, the lowest premium since ADP began tracking the data 3 years ago. The leisure and hospitality sector, which led job creation during the pandemic recovery, recorded a loss of 7,000 jobs in November. Trade, transportation, and utilities added 55,000 positions, while education and health services contributed 44,000. Service-related industries provided all job gains, and goods producers saw a net loss of 14,000 jobs. ADP's chief economist, Neela Richardson, noted that the boost from restaurants and hotels in the recovery is fading, suggesting more moderate hiring and wage growth in 2024. The ADP report precedes the Labor Department's non-farm payroll count, which is expected to show growth of 190,000 in November. This report reflects a labor market that is loosening, with job openings declining to 8.73 million in October, the lowest level since March of 21. So, while spending still remains strong, the jobs numbers appear to be starting to get soft. But again, let's wait and see how long this trend lasts. All right, next up, U.S. trade deficit widens in October on weak exports. The U.S. trade deficit expanded more than anticipated in October, reaching $64.3 billion, which may contribute to economic growth headwinds in Q4. The Commerce Department Census Bureau reported a 5.1% increase in the trade gap, with September's data revised to show $61.2 billion instead of its previously reported $61.5 billion. Exports of goods and services decreased by 1% to $258.8 billion, driven by a decline in consumer good exports, while capital goods exports reached a record high at $51.2 billion. Imports of goods and services rose 0.2% to $323 billion, with capital goods imports increasing and goods imports signaling potential softening domestic demand. The trade performance in Q3 had a neutral impact on the economy's 5.2% annualized growth rate, but the widening trade deficit in October suggests it might act as a drag on economic growth in Q4. Growth estimates for Q4 are generally below the 2% target pace. All right. So again, just a little more data that, some things are softening because, the trade deficit had really widened during the beginning of the whole COVID thing when, we basically shut everything down here. And then I think it had gone to about 100 billion per month and had, contracted quite a bit back close to around that 60 billion number. But it does appear to be, kind of creeping back outwards again. All right, last up, article here from Zero Hedge titled "The Money Supply Continues Its Biggest Collapse Since the Great Depression." This was written by Ryan McMacken of the Mises Institute. Let's see what he has to say. All right, the U.S. money supply contracted for the 12th consecutive month in October, with year-over-year growth reaching negative 9.33%, indicating a significant downturn. This decline in money supply growth is remarkable, as the modern era rarely witnesses a reduction in the money supply. The contraction, measured using the true Rothbard-Salerno money supply, is the most substantial seen since the Great Depression. The TMS money supply has fallen by 2.8 trillion, 13.1%, since its peak in April of 22, marking the largest proportional drop since the Depression. Despite the reduction, the overall money supply remains elevated compared to the period from 1989 to 2009. The monetary slowdown has weakened the economy, reflected in indicators such as the Philadelphia Fed's manufacturing index and rising default rates. The Federal Reserve's decision to raise short-term interest rates has contributed to this trend, signaling a shift away from a prolonged period of easy money. The rise in interest rates has led to increased commercial bankruptcy filings and a surge in mortgage rates, impacting lending for private consumption. This situation suggests an unsustainable bubble that is beginning to burst, presenting challenges for the Fed to navigate between avoiding a new surge in inflation and preventing an economic downturn. A reversal of the Fed's easy money policies could stabilize the economy, but it may come at a cost. of enduring economic bubbles and a necessary transition to a more sustainable economic model based on savings and investment rather than artificial stimuli. All right. So we'll see that, again, a lot of our, a minute ago I talked about energy. The other big canary in the coal mine was all of the money we printed 3 years ago, and going from I think 16 trillion up to about 22 trillion in the money supply. That had huge effects on inflation, and so we're not down, we're nowhere near back to, even if you were to trend line that out from where we were trending, we're nowhere close to being back to what might be considered normal at this point. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a wonderful evening, and I shall talk to you next time. Adios.